Welcome to part 2 of our reading on non-current, i.e. long-term liabilities. Now, in part 1 we were looking at bonds, in part 2 we're going to move our attention to leases. And our first learning outcome here says to describe the motivation to lease rather than purchase. So in other words, they're saying, look, you can either lease an asset, alternatively you could go out and borrow the funds and acquire an asset. So what are the advantages? Number one, short period of use. So maybe we want to use an asset for less than its potential life. So rather than buying the asset and then having to dispose of it, why not just lease it for the period where you need to use it? Cheaper financing, well, you might find that the interest rate within a lease is lower than the interest ratios are debt over debt plus equity, or of course debt over equity. Now remember, the CFA Institute uses a definition called total debt for debt, and that total debt is essentially interest-bearing current liabilities and interest-bearing long-term liabilities. Remember, when we look at equity, we're talking about all of stockholders' equity. We're talking about the common stock, the additional paid-in capital, the retained earnings, and the comprehensive income items. Now, of course, our leverage ratios are very much taking a balance sheet focus. You can see the figures come from the balance sheet, looking at how much debt we have within the firm's capital structure. Certainly that first ratio, debt over debt plus equity, it's showing you the percentage of debt within your capital structure. We then have our coverage ratios, and of course our classic coverage ratio is interest coverage, where we look at EBIT divided by interest. It's a safety ratio. It's looking at how comfortably we're making our interest payments. Okay, so here are our ratios, our leverage ratios. Again, we've seen them in an earlier study session anyway. Notice we've got our total debt ratio. Notice total debt is interest-bearing, short-term and long-term debt. All interest-bearing liabilities, in other words. Debt to assets, otherwise known as the total debt ratio, is total debt over total assets. Again, typically you'd want the debt to be lower than the assets. Logic being is you could sell off the assets and pay down the debt with the proceeds. Debt to capital ratio is simply our debt over debt plus equity, so it's showing you the proportion of total debt within your capital structure. Debt to equity ratio is just displaying this information as a ratio rather than as a percentage. And then the financial leverage ratio, which of course was part of our DuPont analysis earlier. And that's why it's using averages, because it's part of calculating ROE. Average total assets over average total equity. Now remember, the argument is, if your assets were purely financed out of retained earnings and equity, then the ratio should be close to 1. Once you start to purchase assets using debt finance, well, the asset figure on our numerator is going to go up, but of course equity will be unchanged. So essentially the ratio will start to climb above 1 once we use debt to finance our acquisitions. Here are our major coverage ratios. Interest coverage, a classic ratio, EBIT over interest payments. Safety ratio, looking at how comfortably we're making our interest payments. Fixed charge coverage says, look, interest isn't the only fixed charge you've got. You've also got the payment on leases. So it takes EBIT, earnings before interest and tax, and adds back lease payments. And on the denominator, it includes both interest and lease payments. Okay, you'll be pleased to know that we finished our reading.